Value investing is a strategy where investors buy stock undervalued by the market. This means the stock's intrinsic value is higher than their current stock price in the open market. After all, you wouldn't want to pay more for something than it's actually worth, right? So let me show you through example how I perform value investing through fundamental comparative analysis to find discounted stocks. Fundamental comparative analysis is the process of evaluating and comparing the financial fundamentals of different companies, typically within the same industry, to identify stocks that appear undervalued relative to their peers or historic norms. Typical steps I take in fundamental analysis involve screening, valuation, understanding the company, deeper financials, potential cons, and then a decision. Let's start with what is a fundamental stock screener. A fundamental stock screener is a tool that filters and ranks stocks based on fundamental analysis metrics like valuation, profitability, potential growth, and financial health to help investors identify potentially undervalued or high-quality companies. I have a stock screener tutorial in both Power BI and Python. In the Power BI version, I walk through how we can use TradingView stock screener data to calculate industry average multiples to then compare against individual stocks. In the Python version, I walk through how we can gather historic financial data using the Yahoo Finance package to calculate multiples and automate this comparison analysis process for us. Check out both of these tutorials in the description and top right. Let's walk through how a stock screener can be helpful. For example, let's say we looked at the price to free cash flow multiple of a company in an industry. Let's say the company's annual price to free cash flow is 3. This means that investors are willing to pay $3 for every $1 in free cash flow the company generates. But let's say we calculate the price to free cash flow for all stocks in the same industry, and the industry average price to free cash flow comes out to $15. This means that investors are willing to pay 15 or 5 times more on average for every $1 in free cash flow that other companies generate. So the natural next question to ask as a value investor is, why is this stock getting penalized and trading so cheaply compared to its peers in the same industry on a free cash flow perspective? Is this company facing bankruptcy risk? Is sentiment around this stock negative because of poor earnings or lack of potential growth? Or maybe simply this company is obscure with a lack of analyst coverage. This is the art of investing. We have to dictate whether a stock deserves to trade at a discount or the stock deserves to rise in stock price. So what is an example of an undervalued stock? Right now, I believe DNOW is an undervalued stock. We can perform comparative fundamental analysis and calculate industry multiples and compare them against DNOW's multiples. So let's see how discounted DNOW stock is. DNOW trades at a price to sales of 0.65, while the wholesale distributors industry average trades at 12.5. This means that investors are only willing to pay 65 cents for every dollar in revenue DNOW generates. DNOW's market cap is worth less than the company generates in revenue in the last full year. At the same time, on average, investors in this industry are willing to pay $12.50 for every dollar in revenue generated. This discount is even more clear when DNOW grew annual revenue last year by 2.2%, when on average the industry revenue shrunk by 3.4%. So DNOW, from a revenue standpoint, trades at a significant discount. The stock's market cap is less than the annual revenue DNOW generates, and the annual revenue growth is increasing rather than contracting compared to the industry. Now we have price to book, which compares how much investors are paying for each dollar of a company's net assets. DNOW trades at a price to book of only 1.34, while the industry average is 44. When price to book trades near 1, then that means the stock trades close to its accounting value. This makes me believe there is limited downside risk for DNOW stock, because if DNOW's price to book trades below 1, then that means the stock's market cap is worth less than the stock's net assets, worth less than DNOW's entire inventory, properties, software, and proprietary technologies. If DNOW ever trades at $10.76 or below, DNOW's price to book will be at 1 or below 1, making this price a steal for this stock. Next is EBITDA, which is enterprise value over EBITDA, or a method to calculate a company's cash earnings from operations. This multiple shows us how much investors are paying for the company's operating cash flow. DNOW trades at an EBITDA multiple of 7.8, while the industry average is 13.7, nearly twice as much. Finally, we have price to free cash flow. DNOW trades at an 8.2 multiple, while the industry average is 24, 3 times more. But in contrast, DNOW grew annual free cash flow 69% last year, while the industry on average grew free cash flow only 24%. So DNOW is growing free cash flow faster than the industry average, but trades at a discount. Now that we have explored popular financial multiples for fundamental analysis, walk through DNOW as an example of a potentially undervalued stock, let's actually understand what DNOW does as a company. After all, although Benjamin Graham is the father of value investing, Warren Buffett polished value investing, emphasized not only the stock's price, but also the business quality and economic moats. DNOW distributes downstream energy and industrial products for petroleum refining, chemical processing, LNG terminals, power generation, gas utilities, and customer on-site, off-site locations in the United States, Canada, United Kingdom, Norway, Australia, Netherlands, Singapore, and Middle East. DNOW's products are pipes, valves, and pumping solutions to distribute energy across energy distribution networks. Not only does DNOW sell these machines, but they also provide services like their DNOW platform, which helps customers achieve supply chain management and material sourcing. The platform helps customers buy specific parts or order custom parts that fit their energy flow. DNOW is also automating inventory management through their Access Now platform. So instead of manually tracking all your equipment and manually ordering what you need, DNOW will use data cameras to monitor the forecast, the items your company needs. So to wrap up, DNOW is a supplier, designer, and engineering company that helps build energy and industrial products. These products are applicable in many industries. Take oil and gas, for example. You have to drill and then transport these oils and gases through pipes and valves, along with safety gear and complex systems. Sure, there's a green transitioning happening, but oil and gas are not going to vanish overnight. Now let's look at the financials. I like DNOW's balance sheet with $219 million in cash and short-term investments and no long-term debt, enabling the company to focus on growth. The EBITDA grew to $46 million even during flat U.S. rig business. DNOW also trades near historic price-to-sales ratios, meaning the company may be near discount values relative to its historic self on a revenue basis. A potential con about DNOW's financials is their negative free cash flow in the most recent quarter, which may signal operational inefficiencies, though the past 5 consecutive quarters have been positive. Now let's look at the current economy. In my Oxy stock analysis video, I mentioned how making oil companies drill more in the drill baby drill agenda might actually hurt oil companies because supply would exceed demand, causing prices to go lower while the oil companies need to increase operational expenses. DNOW instead may benefit from such a policy because if U.S. oil production were to expand, then oil companies would need to buy supplies to build and improve these oil rigs and transport the energy through valves, pipes, and pumps, the technology that DNOW sells. Overall, I like DNOW's current stock price. It's currently trading near a price to book of 1, so there seems to be minimal drawdown risk as the company has no long-term debt, generates stable revenue, and has a diverse product portfolio to address customer needs. The stock has upside potential as it increases annual free cash flow faster than the industry average and brings in more revenue than its current market cap is worth. If you would like more examples of discount stocks, check out my Galat and Flex Steel stock analysis videos. I hope you enjoyed this fundamental analysis walkthrough on how to research stocks and find potential discount stocks. Thank you for watching till the end. If you found the video helpful, consider sharing the video, and I will see you all in the next one.
Of time before someone else sees this investment. We have to act